Hey everyone, it is Evan here from the TradeRisk.com, and in today's video we're going to be discussing market internals and how they can improve your trading. If you're finding this video natively on YouTube, we have a complete blog post outlining everything we're going to discuss here with links, images, examples, pictures, everything there. If you rather read the full text format, you can find a link below this video in the description, or we'll link it up right now appearing in the top right hand of your screen. You can click that and you can be directed to the full post here outlining everything we're about to discuss. So with that, let's get into the video. Let's get into the topic for today. We're going to start by defining what are market internals, what is market breadth, and the two terms are used synonymously by most traders. When people refer to market breadth indicators, market internal indicators, we're really talking about the same thing. Market breadth seeks to measure the quality of the market environment using the total number of individual stocks participating in a move. And we're going to show plenty of examples and we're going to get into the details here. So if that's a little confusing still, don't worry about it. We're going to start to break that down. But market internals are simply measurements of the internals of the market, which represent exactly that of market breadth. So the goal here with both of these, either market internals, market breadth, whatever term you prefer to use, we're trying to get beyond price and take a look at what is the general stock out there doing. That's what we really care about. And this can help and assist in your trading pretty dramatically, as we're going to go on to look at here with some different examples. So why should we care? It's easy just to look at the return of the SPY, right? We can go to the S&P 500, go to the SPY ETF and say, okay, we're up 1% today. Stocks are doing well. The issue is that would actually be very lazy and also inaccurate. One major flaw with that approach is the fact that the S&P 500 is a market cap weighted index. So that means the larger the company is based on market cap, the more of an effect it has on the returns of an index. So if we had a day where Amazon, Apple, ExxonMobil, they were all strongly green on the day, it really doesn't even matter what the bottom 30, 40, 50, 60% of S&P 500 stocks are doing. The fact that those big 3, 4, 5 leaders are all up, that's going to skew the index into positive territory and can lead you into sort of a false sense of security that everything is good, the market's healthy, pile on the long exposure. And we're going to get into some specific examples of how we can sort of flush those sort of discrepancies out. Now let's get into how market breadth can actually help us trade. So most of the time, market internals should, and they do, align with what the major averages are telling us. So in other words, the narrative between price and the narrative between market breadth, if price action, if the S&P 500 is up 1% on the day, generally speaking, market internals are going to be up on the day as well. They're going to be confirming what price action is doing, and everybody is happy. It's really the disagreements that we care about and that we should be on the lookout for. So it's divergence that is one of the most powerful pieces of information that market internals can provide to us. And when used properly, they can save or make us quite a bit of money. So that is the number one thing to look out for when using market internals. The second application is really additional market context, a regime filter of sorts. By studying the trend of what market internals they've been doing, so how they've transitioned, how they've kind of coincided and moved with price over the recent history, depending on your time frame, and what it's doing now, and perhaps that relationship that you're constantly studying and just checking in on, they can start to give you some pretty good insight into how strong the underlying market really is, the health of the market, if something is starting to weaken up and starting to get onto shaky ground. These are all things that we can define and look at a little more concretely, and we're going to do that as we start to get into some of these examples. So with that, let's move into some specific market internal indicators, and we're going to share with you some of the tips that I've learned over the years using these and studying these for years now, every single day, monitoring them, and I'm going to show you some tips that really help me out over my trading. So we're going to start with the advanced decline line. This is by far the most common market breadth internal indicator out there. This is sort of the most cited and most well used and known. So let's define it real quick. The advanced decline line is a stock market technical indicator used to measure the number of individual stocks participating in a market rise or fall. So a little cool tip here is that this can actually be used on different exchanges, different sectors, your favorite watch list. We can create an advanced decline line for any universe of stocks. Most commonly, it's used on the NYSE, which is certainly one of the largest all stocks on the New York Stock Exchange. Very, very broad-based sort of measure of what the AD line is. But again, you can use it on specific sectors and other industries, if you will, and you can start to really granularize sort of the breadth and the health of very narrow sectors and slices of stocks. So how does it work? Really, it's quite simple. Count up all the stocks that are up on the day, count up all the stocks down on the day, take the difference, and that's your AD line. So it's as simple as that. And again, you can use that with any universe that you like. Most commonly, of course, though, is the NYSE. So let's take a look at what it looks like on a day-to-day basis. This is the 2016 data seen here, and this is just each individual bar is a day. So you can see there's lots of noise here, and this universe here rotates in between approximately 2,800 stocks. Again, this is the NYSE advanced decline line. So you can see you get ranges in between generally, plus and minus 2,000, and then you have a lot of kind of noise between plus and minus 1,000 is sort of where most stocks fall, the standard deviation of a general move, and then you have those outlier days where you have strong movement in one direction. So how do we use this? How do we actually make sense of this seemingly very noisy piece of data here? In general, you want to see day-to-day market action consistently confirmed by the AD line. So just like you would use volume for a stock chart, your favorite stock, you're looking at volume patterns, I look at advanced decline line the same way. You want to see up days consistently consistently performing with strong advancers versus decliners. And when you get pullbacks in the market, you don't want to see extreme lows. You don't want to see a lot of selling pressure, as it were. You don't want to see a lot of stocks sort of moving downward. You want to see those things maintained to just lightly bearish levels when things are pulling back, and you want to see expansion on the upside. So just like you would look at volume, that's the way you can interpret this on the advanced decline line. Strong sessions, plus or minus 1,000, when you start to get beyond those readings, that really shows you some institutional buying or selling on that day. That generally means when you're reaching and getting above plus or minus 1,000, you got about 65% or more stocks that are all moving in one direction. So that's more than just you and I selling or buying stocks. Those are big institutions out there that are moving large piles of money that are influencing the market. So those are days that you really want to sort of pay attention to. I consider them stronger accumulation days or stronger distribution days when you have those types of moves. And again, sometimes that's a climactic move. Sometimes, if you've had 3 or 4 days down and then all of a sudden you have this big, minus 2,000 day, that could be a climax. But again, they're sort of breadcrumbs and clues as to what institutions and some of those big money is doing. So that's a useful sort of threshold, again, when you're on the NYSE universe. Choppy sessions, really, plus or minus 500 in between that range. I have 400 down here, but anything, that's just kind of subtle in hovering just above or below the zero line basically tells you that there's not much action going on that day. It's very choppy, just a lot of traders, mean reverting type of day, digestion type of day. That's generally how I interpret those very narrow ranged sessions. So that's the AD line printed day after day. Let's take it another step further, and we're going to kind of circle back to the AD line in a little bit later, but let's talk now about the McClellan Oscillator. This is one of my personal favorites. The McClellan Oscillator is a market breadth indicator that is based on the difference between the number of advancing and declining issues on the NYSE. So that definition should be familiar. The McClellan Oscillator just simply uses the advanced decline line that we just talked about. It's a derivative on top of it, and specifically it's calculated by taking the difference between a 19 period and a 39 period EMA. That difference is the value of the McClellan Oscillator. So think of it as a MACD. It's a simple momentum indicator on the advanced decline line. So it's pretty powerful, gives you one extra layer, and it helps smooths out price, or not price as it were. This is actually the AD line, so this helps smooth out the number of stocks advancing versus declining. And we're going to look at an example and a picture of the 2016 data right now. So you can see the McClellan Oscillator really kind of smooths out that prior chart that we looked at, and you can start to get a little more maybe actionable signal out of this. So how do we use it? Above and below the zero line, this is a classic sort of point of control. So above the zero line is considered to be bullish sort of momentum or bullish strength in market internals. Below it is sellers are in control. Extreme readings, this is an oscillator after all, so it's naturally bounded on both sides, and it tends to be mean reverting. So you can look at extremes in the McClellan Oscillator, in the oscillator itself, and you can start to anticipate or project that we would get some mean reversion after some unknown amount of time. It could happen right away, it could take some time to go back to the mean, but in general, it always finds a way back there. Depending on the charting platform you use, the values are going to be calculated a little differently, the numeric numbers. So on our chart here that we're looking at, plus or minus 60, 65, that generally gets into quote overbought and oversold territory, and that's where you start to expect some mean reversion. But there are other charting platforms that have larger numbers there, so it might not be plus or minus 65. You're really just going to need to go back and sort of look historically where you see the oscillator start to get extended and start to mean revert. Sharp moves, reversals, and accelerations, I think these are always very interesting days. It doesn't really matter the positioning. It could be on the upside or on the downside, but anytime you have a real sharp move here, it's something I pay attention to for continuation in that direction, for change of character. That tells me that something has changed when it gets a sharp move in either direction. So that's something I generally pay attention to, and you can start to see those, from one bar to the next. If you start to see a big change there, I think that's a day to take notice. And divergences versus price. We talked about divergences a few slides ago and how they can be pretty powerful. Well, the McClellan Oscillator can give you some good divergence signals when, let's say, for example, price, the S&P 500, is rising to new highs, and we have a situation where perhaps the McClellan Oscillator is stuck near the zero line and it's reluctant to move higher. That's a divergence. So when you have price moving higher, and let's say the McClellan Oscillator going flat or barely going up, or even worse, going down, those types of divergences are when you can get some real sort of actionable and potentially very interesting trade opportunities ahead of you. Okay, that's the McClellan Oscillator. Let's move into net 52-week highs or lows. So 2016 data, you can see it here. This is the net 52-week highs / lows. How we calculate this: add up all of stocks making 52-week highs, add up all the stocks making 52-week lows, take the difference. So that difference is your net new 52-week highs or lows. Traditionally, we use this on the NYSE, but again, this could be used on any universe of stocks. And again, you can see this is pretty clean looking data set here. It's not as noisy as, say, the advanced decline line that we originally looked at. And now let's talk about how we can use it. So on its very simplest terms, confirmation is the first way we would look at this. And very similar to the AD line, when markets are rallying, you want to see confirmation here in stocks making new highs. It's very simple. When things are moving up, we want to see expansion in highs to the upside. That gives us the most confidence that this rally is for real. There's real buying pressure. There's real stocks moving up. There's real money flow. All of those things kind of are confirmed when we have expansion in highs, or if you're on the downside, if you're in a bear trend, you want to see expansions in lows to really show weakness out there if you're looking to short things or, just step aside, hedge, however you want to approach it. On the flip side, divergences are, again, key here, as they are with pretty much every other internal indicator. When things are going up, you want to make sure they're going up. And if they're not, then you clearly have a divergence. That's something you should be aware of and on alert for. Divergences on this particular indicator are more longer term in nature. So generally, maybe not generally is the right word, but there are times where you can have divergence on this indicator, on 52-week highs / lows. You can have this diverging for days, weeks, even months before price action really responds to it. And that's something you should pay attention to. It's good on one hand because it gives you plenty of early warning if something isn't right or isn't acting right. But at the same time, if you immediately sell when you start to see a divergence, price could continue moving higher and you might miss out on some of that rally. It's, again, all about market context. And just be aware, from my experience, 52-week highs can diverge for a period of time. There's the note down there. So pretty straightforward application for this particular indication. Now let's move on to the cumulative AD line. So this AD line is, circle back to our original advanced decline line. This is calculated by simply appending each day to the next. So instead of looking at that individual very noisy bar chart that we originally looked at, or histogram chart that we looked at with the AD line, this simply takes every single day and adds it to the prior day. So it's the same data set that we've already looked at, so we know what this is. It's based on the number of stocks either moving up or down on the day. And how we can use it here, again, is confirmation and divergence, the same exact things, same exact sort of rationale that we just talked about with net 52-week highs. The beauty of this sort of view of the advanced decline line is that you can start to add moving averages on it, rate of change indicators, momentum indicators. You can define trends. You can use higher lows and higher highs. So you can actually apply some simple technical studies and start to observe divergences or confirmation much easier than, say, that day-to-day AD line. And you can start to really compare this chart versus the S&P 500. So, for example, you could throw a 10 SMA on here, or 20 SMA, and 20 SMA on the S&P 500, and you can start to see, well, if one starts breaking down, there's some relative weakness to the other one. You can also make sure that instead of using the NYSE data set here, you could also just use S&P 500 data set, so you're really comparing sort of apples to apples. You can take this very kind of far and get very advanced on this very quick if you want to start getting more complicated technical analysis and doing some correlation studies. You can really kind of go down a rabbit hole here, but the cumulative AD line just gives you a cleaner, more intuitive feel than perhaps the day-to-day histogram chart that we looked at before. Confirmation and divergences, though, are the root here of how you can apply this to your own trading. So finally, stocks above a moving average. So 2016 data seen here. Now, this is the percentage of stocks that are above a 10-period SMA. So again, this is an oscillator. We have basically a zero line, not quite zero line. We have a mean line, which is the midpoint. And this is going to rotate, or this is going to oscillate in between 0 and 100. That's a percent that represents the percentage of stocks above the given moving average. So how do we use this? Above and below the mean, just like the McClellan Oscillator, instead of the zero line, we're using the mean line, which is generally going to be 50. But the great thing, and sorry, I should have started with this. This chart is from indexindicators.com, great website that provides intraday and end-of-day data for all of these charts. And the great thing about their charts is they actually display on here the accurate mean based on the data set. So for 2016, the mean was at 54.08. And just like the McClellan Oscillator, if we're above the mean, we generally interpret that as buyers in control, as bulls having momentum, bulls having some upside control. If we're below it, then sellers are in control. So very basic way, kind of black and white, just to look at the general positioning there on where we are in the oscillator. And overbought and oversold zone. So again, great thing about index indicators here is they give you the 1 and 2 standard deviation levels. So again, we can see really at the end of 2016, you can see how it's in between that 1 and 2, -1 and -2 standard deviation zone, right around the 20% mark. And that generally tells you that stocks are oversold here, that we are in an environment where we've seen enough selling pressure that we're historically at, especially on a year-to-date basis here, we're at levels that generally get a bounce. So that can give you some good market context. Maybe you want to get off your shorts. Maybe you shouldn't be pressing shorts. Maybe you want to be buying some longs, putting on some exposure for a bounce. All depends on sort of your time frame and strategy, but I think you could really kind of see and draw the trading applications based on how this indicator is moving and the positioning of it. One other piece of advice, or a couple of pieces of advice here: don't, just because it comes into this, even where price is now, this 1-2 standard deviation zone, doesn't mean you should, -1 or 2 standard deviation zone, doesn't mean you should be, buying everything, margining out the account, looking for an immediate bounce higher. These things can stay oversold for periods of days, sometimes weeks, and the timing on it is still going to be, something that your strategy, your actual execution rules are going to need some refinement on. So don't just see it drop down here and try and just, put it all on for a quick bounce. When there's momentum to the downside, you need to respect that. So that's just one general observation. The other point I want to make here is you can use any period moving average. We're looking at a 10-period moving average. I'm partial to this. I like looking at a very fast short-term 10-period SMA. But if you want to extend out the time frame, you can use a 50-period moving average or a 200-period moving average, and that's going to show you, the stocks that are above those moving averages respectively, and those will give you longer time frames, longer market outlooks than what you're seeing here. Less oscillations, less noisy kind of movements, and a smoother sort of longer term view of, quote, the health of the market. So those are, this is finally the last one we're going to talk about today, a great way to visualize sort of the health of the market and just get an understanding of what stocks are doing. So market internals, wrapping sort of the indicators up in what we've talked about here. By tracking what's going on under the hood of the market, we can be more selective with the environments we trade in. So institutions, as we talked about, move markets, and internals are one of the clearest way to track their activity. Now, I know we didn't necessarily get into specific trade examples. I didn't show you any of perhaps market opportunities side by side, looking at divergences and how that can play out in the market. I'm happy to do a follow-up video if there's enough interest in that, but it just really comes down, there's lots of different ways you can interpret and use this and apply this to a trading strategy, and everybody has different trading strategies. If you're really tactical, there's some clear relationships here, but if you're a longer-term positioning trader, there's ways you could just use this to hedge a little bit, maybe to trim some exposure off, to write calls against. There's just so many different ways to kind of draw the conclusions, to map sort of to a specific trading plan that I didn't want to show specific examples, but I'm happy to do sort of a follow-up video. And keep in mind, all of the tips and suggestions and sort of lines of thinking for these different indicators should not be assumed to be the right way or the only way to use them. These are simply the way that I've come to use them and my sort of thought processes about some of these indicators. You may have completely opposite views. You may use them differently. And of course, there's a million ways to sort of slice all of this information and data. Ultimately, it's what makes sense for you. But hopefully, some of these tips can find some use in your own trading process. So before we wrap up, I want to spend one moment talking about stock market breadth cycles. So this is an indicator that I've created. As you can tell, I've spent quite a bit of time looking at these indicators, using them, studying them throughout my trading career, and I've always had an interest in sort of simplifying everything and making things a little more actionable. So what I've created are these breadth cycles, and you can see it overlaid here on the S&P 500 for 2016, and here's what they are. A breadth cycle is a unique way of measuring the health of the market environment based exclusively on market internal data. So everything we talked about basically is what a breadth cycle is derived from. And we calculate two cycles, one for active traders, another for longer term position traders. Really, in a more refined sense, our short cycle is designed for the next 3 to 8 to 10 days, 3 to 10 days basically of market price action. That's what it is. It does a good job sort of forecasting or describing. Our longer term cycle is really a month or longer. And cycles are broken into 3 different states: green, yellow, and red, corresponding to the health of the market. And that really is, as you might guess, bullish, neutral, essentially choppy, or bearish price action. So take a look at this example here. This is our 2015 long-term cycle overlaid on the S&P 500, and you can see as price moved sideways in that 4% range for about 6 or so months through March through August, our cycle state moved from bullish green to more of a neutral, choppy zone throughout May and June into the bearish state before the market experienced a 12% drop in August. So essentially what it was picking up on was weakening market internals, and our cycles did a great job at sort of warning us of some potentially dangerous price action that was upcoming, and we saw that manifest itself in that August drop. So the benefits of breadth cycles, really everything that we talked about today is essentially the benefits of them. They complement traditional price action setups because they take a look at the internals of the market. They can act as a powerful early warning signal like we just saw in that example. And you can trade more confidently when you're aligned with those cycles. Everything that, these 3 bullet points are the same sort of pros that we discussed in each of the individual breadth indicators. There's just simply outlined here in a cleaner sort of stoplight, red, green, yellow format, so they're a little more intuitive and they're a little more simplified rather than looking at 5 or 6 different indicators and trying to figure out what kind of divergence there is. We have this all sort of simplified and aggregated together in one simple and easy to use indicator. So I have plenty more examples and info on these breadth cycles on the trade risk. So there's a link below this video. If you're interested in reading more or just learning more about them, then by all means, please take a look on the website, follow the link below, or I can try and get one appearing in the top right-hand corner now to bring you right to that page. Otherwise, that's about it. So thanks so much for getting to the end of this video. If you made it all the way through, almost 30 minutes long, feel free to connect or contact me. All of my information is here. So you can find me on StockTwits and Twitter, thetraderist.com, this YouTube channel, of course, and there's my email if you have any questions, feedback. Love to hear them. If you like the video, give it a thumbs up. If you don't, tell me why, or don't give it a thumbs down. That's not nice. So I'm just kidding. But have a great day. Thanks for watching this, and hope to see you guys and talk to you guys soon.